How did a handful of merchants sitting on wooden benches in Italian marketplaces transform into the architects of the global financial system we know today? What drove these medieval innovators to develop tools and techniques that would revolutionize commerce across continents? And how did the bustling city-states of Florence, Venice, and Genoa become the birthplace of modern banking, creating systems so sophisticated they still underpin our economy centuries later? To understand the entire story of how medieval Italian bankers created modern banking, from the first money changes in the grain markets to the collapse of the great banking houses in the 14th century, we have to go back to the very beginning. In the late 11th and early 12th centuries, Europe was emerging from what historians call the Dark Ages. The collapse of the Roman Empire centuries earlier had led to deep economic depression, sharp deflation, and sluggish monetary circulation. But by the dawn of the 12th century, something remarkable was happening. Trade was reviving, cities were growing, and a new merchant class was rising to prominence. And at the heart of this transformation were the Italian city-states. Italy wasn't a unified nation in the medieval period. Instead, it was a patchwork of independent city-states, each with its own government, its own ambitions, and its own economy. Cities like Florence, Venice, Genoa, Siena, Lucca, and Milan competed fiercely with one another for trade and influence. This competition bred innovation. These cities needed to find ways to finance their merchants, protect their wealth, and facilitate trade across vast distances. And so, almost by necessity, they invented banking. The word bank itself tells us something about these origins. It comes from the Italian word banco, meaning bench or counter. In the great grain markets and trading piazzas of Lombardy and Tuscany, merchants would set up wooden benches where they exchanged currencies, accepted deposits, and made loans. These weren't grand institutions housed in marble buildings. They were simple operations conducted in the open air with nothing more than a bench, a ledger, and a merchant's reputation. When a banker failed to meet his obligations, his bench would be broken as a public symbol of his insolvency. This gave rise to the Italian term bancarotta, literally broken bench, which evolved into our modern word bankrupt. Similarly, when we say someone is broke, we're echoing this ancient practice of shattering the benches of failed bankers. But before we delve deeper into the Italian innovations, we need to understand a critical event that stimulated the rebirth of banking in Western Europe: the Crusades. In 1095, Pope Urban II stood before a crowd at the Council of Clermont and called for a holy war to reclaim Jerusalem from Muslim control. This ignited the Crusades, a series of religious military campaigns that would last for centuries. The Crusades created an enormous logistical challenge. How could European nobles and their armies travel thousands of miles to the Holy Land, fund their military campaigns, and ensure their wealth remained secure while they were away? Enter the Knights Templar. Founded in Jerusalem in 1119, the Knights Templar began as a military order charged with protecting Christian pilgrims traveling through the dangerous territories of the Levant. But within a few decades, they had evolved into something far more sophisticated: Europe's first international banking institution. The Templars offered pilgrims and nobles a revolutionary service. A traveler could deposit their gold and valuables at a Templar commandery in their home country and receive a coded letter of credit. This letter could then be presented at any Templar location along the routes to Jerusalem, where the holder could withdraw funds as needed. No longer did pilgrims need to carry heavy chests of gold guarded by armed men. The Templars had invented the first system of secure international money transfer. The Temple Church in London became what one modern columnist described as the Western Union of the Crusades. The Templars stored wealth for individuals of all classes, collected deposits, made loans, and even handled tax collection and accounting services for several European states. Their reputation for honesty and security was unmatched. Theft or misappropriation by Templar members was punished severely, sometimes with death, which ensured their trustworthiness became universal. The Templars also pioneered ways to circumvent the strict Christian prohibition against usury. Since charging interest on loans was considered a mortal sin, the Templars got creative. Instead of charging interest directly, they would receive compensations for hardships, or they would charge rent on money rather than interest, or they would build fees into foreign exchange rates. Some loan contracts from southern France included clauses stating that if the currency depreciated between the loan and repayment, the borrower had to add a fixed sum to compensate. This fixed sum often concealed what was effectively an interest charge. By the mid-13th century, the Templars had become astonishingly wealthy. They owned vast land holdings across Europe, ran commercial enterprises from salt mills to cloth manufacturing, and managed the finances of kings. But their wealth and independence proved to be their downfall. In 1307, King Philip IV of France, facing massive debts to the Templars, orchestrated their arrest on charges of heresy. The real motivation was financial. Philip wanted to eliminate his debt and seize the Templars' assets. The order was dissolved in 1312, but the banking innovations they had pioneered lived on. Italian merchants and bankers had watched the Templars closely. They learned from the order's successes and understood the enormous demand for financial services across Europe. By the time the Templars fell, Italian bankers were ready to fill the void. The 12th and 13th centuries saw Italian city-states flourish as trading powerhouses. Venice and Genoa, two of Italy's four great maritime republics, controlled trade routes to the Byzantine Empire and the Orient. Their ships brought back silk, spices, precious metals, and other luxury goods that fetched enormous prices in European markets. Florence, though landlocked, dominated the wool and textile trade and eventually conquered the port city of Pisa in 1406, giving it access to the Mediterranean. This explosive growth in trade created complex financial challenges. How could a Venetian merchant pay a supplier in Flanders? How could a Florentine wool trader transfer funds to London without physically moving heavy bags of gold coins across dangerous roads? How could merchants keep track of increasingly complicated business transactions involving multiple parties, different currencies, and extended credit terms? The Italian merchants answered these questions with a series of revolutionary innovations. By the early 13th century, three distinct classes of banking professionals had emerged in Italy: pawnbrokers, money changers, and deposit bankers, and merchant bankers. Pawnbrokers were the most basic lenders. They made small loans to individuals who pledged personal property as collateral. These loans helped common people through hard times, but the pawnbrokers operated on a small scale. Money changers occupied a more respectable position. Europe in the medieval period had dozens of different currencies, each issued by different kingdoms, city-states, or even local lords. Travelers and merchants constantly needed to exchange one currency for another. Money changers provided this service for a fee. They converted florins to pounds, ducats to marks, and managed the bewildering array of coins circulating through medieval markets. The most sophisticated were the merchant bankers. These were wealthy merchants who had accumulated enough capital to move beyond simple trade and into finance. They accepted deposits, made large loans, facilitated international payments, and provided credit for commercial ventures. The merchant bankers of Florence, in particular, came to dominate European finance. Among the earliest banking centers was Siena, where merchants had been active at medieval trade fairs since the 1210s. The Bonsignori family, sometimes called the Gran Tavola or Great Table, became Siena's most powerful banking house. They arranged loans to the Pope and established the special relationship between Italian banking and the papacy that would define medieval finance. But Siena's dominance didn't last. In the 1290s, the French king Philip IV confiscated Sienese merchants' assets in France, and Pope Boniface VIII began favoring Florentine banks. The Grand Tavola was dissolved in 1298, and Florence emerged as the new center of European banking. Florence had several advantages. It was the heart of the wool textile industry, producing some of the finest cloth in Europe. It had established trade connections across the continent. And it was home to an extraordinary concentration of merchant families with capital, ambition, and innovation. By the early 14th century, Florence was home to around 80 banking houses. The most powerful were the so-called super companies, the Acciaiuoli, Mozzi, Bardi, and Peruzzi families. These weren't small operations. The Bardi Company, the largest of all, had 13 branches scattered across Europe in Barcelona, Seville, Majorca, Paris, Avignon, Nice, Marseille, London, Bruges, Constantinople, Rhodes, Cyprus, and Jerusalem. The Peruzzi were nearly as extensive, with branches in most major European trading centers. These super companies traded in everything from grain and wine to high-quality woolen cloth. But their greatest profits came from financial services, currency exchange, loans, and the bills of exchange that would revolutionize medieval commerce. Italian merchants developed the solution: double-entry bookkeeping. Double-entry bookkeeping was a revolutionary accounting system that recorded every transaction twice, once as a debit and once as a credit. For every florin that went out, there had to be a florin that came in. Assets had to equal liabilities plus equity. This system created a built-in check against errors and made it easy to see at a glance whether accounts balanced. The technique likely originated somewhere in the Mediterranean trading world, possibly among Jewish merchants who had preserved ancient practices from the Middle East. But it was Italian merchants who perfected it and made it standard practice in European banking. The earliest documented use of double-entry bookkeeping comes from Genoa in the late 13th century. By the early 14th century, major Florentine banks were using the system routinely. It allowed them to track the complex web of transactions moving through their accounts, to calculate profits and losses accurately, and to spot problems before they became catastrophic. In 1494, a Franciscan friar named Luca Pacioli published Summa de Arithmetica, Geometria, Proportioni et Proportionalita, which included a 150-page section explaining double-entry bookkeeping in detail. Pacioli's treatise wasn't the invention of the system, but its publication through the relatively new printing press spread the method across Europe. Soon, it became the standard way of doing business. The impact was profound. Double-entry bookkeeping enabled merchants and bankers to maintain comprehensive records, to plan more effectively, and to manage risk with unprecedented precision. It created a framework for accountability and transparency that became fundamental to modern business. Some historians argue that double-entry bookkeeping was essential to the rise of capitalism itself, as it allowed entrepreneurs to calculate their wealth accurately and to make rational investment decisions. Another key Italian innovation was the letter of credit. Similar to the Templar system, but more sophisticated, Italian bankers issued documents that guaranteed payment to merchants in distant cities. A letter of credit functioned as a promise of payment, backed by the reputation of a major banking house. Merchants could conduct business securely across long distances, confident that the letter would be honored. These innovations, bills of exchange, double-entry bookkeeping, and letters of credit transformed medieval commerce. They made trade safer, more efficient, and far more lucrative. Italian banking houses established networks that spanned from London to Constantinople, from Paris to Cairo. They became the essential intermediaries of European trade. But there was one more element that made Italian banking truly dominant: sound money. In 1252, Florence struck its first gold florin. The florin was a masterpiece of monetary policy. It contained 3.5 grams of pure gold, and Florence maintained this standard with remarkable consistency for nearly 3 centuries. Even during fiscal crises, wars, and political upheavals, Florence resisted the temptation to debase its currency by reducing the gold content. This integrity gave the florin an unparalleled reputation. By the 14th century, it had become the preferred currency for long-distance trade across Europe. Contracts from Flanders to the Levant specified payment in florins. Merchants trusted the florin because they knew exactly what it was worth. Venice responded in 1284 with its own gold coin, the ducat. Like the florin, the ducat maintained its weight and fineness for centuries. The Venetian government understood that its commercial supremacy depended on monetary trust. The ducat circulated widely across the Mediterranean, the Ottoman Empire, and even into Asia. It became the standard gold coin of international exchange, eventually rivaling and even surpassing the florin in some markets. In contrast, kingdoms that debased their currencies, reducing the precious metal content while maintaining the face value, found their coins shunned outside local markets. The Papal States, for instance, frequently debased their coinage, triggering repeated crises of confidence. Foreign merchants refused these unreliable coins or demanded heavy discounts. The lesson was clear. Sound money and commercial trust went hand in hand. Italian merchant banking families like the Bardi, Peruzzi, and later the Medici relied on the florin's stability for their extensive credit networks. The florin underpinned Florence's rise as a banking powerhouse. And then there was the thorny problem of usury. Christian doctrine strictly forbade usury, defined as charging interest on loans. This prohibition was based on biblical passages and centuries of church teaching. Lending money at interest was considered sinful, a form of exploitation that violated the principles of Christian charity. Theologians argued that money was sterile, it couldn't reproduce itself, so charging interest was unnatural and immoral. In the 4th century, Christian councils denounced usury. By 800, Emperor Charlemagne made the prohibition into law. Throughout the Middle Ages, moneylenders were stigmatized, and the church warned that usurers would suffer eternal damnation. Dante Alighieri, in his Divine Comedy, placed usurers in the 7th circle of hell. This created an obvious problem for bankers. How could they profit from lending money if charging interest was illegal and immoral? Initially, Jews filled this gap. Jewish law prohibited charging interest to fellow Jews, but allowed interest on loans to non-Jews. Barred from owning land and excluded from many trades by Christian guilds, Jews in medieval Europe often became moneylenders by necessity. They faced tremendous hostility for this role, but they were tolerated because Christian society needed credit. Italian bankers, however, developed more sophisticated solutions. They found ways to disguise interest charges within legitimate transactions. The bills of exchange, as we've seen, embedded interest in exchange rate differentials. Bankers also made loans that didn't pay interest exactly, but instead promised a share of the profits from the borrower's business venture. This profit-sharing arrangement, called a commenda, or partnership contract, was deemed acceptable because the lender shared the risk. Another loophole involved the distinction between consumable and durable goods. Charging interest on loans involving durable goods like equipment or property came to be seen as acceptable since these items could generate value over time. Rent, for instance, was legitimate payment for the use of property. By the 13th century, the church was softening its stance. The development of the concept of purgatory gave some reassurance to merchants engaged in questionable financial practices they might suffer in the afterlife, but not necessarily eternally. Some theologians began distinguishing between reasonable compensation for risk and opportunity cost versus excessive exploitation. Christian merchants, who found ways to lend money with interest, became known as the Pope's usurers. Their techniques reduced the importance of Jewish moneylenders. By 1327, Avignon, the seat of the papacy at that time, had 43 branches of Italian banking houses. The church itself was borrowing heavily from Italian banks. The papacy needed credit just as urgently as secular monarchs. Wars, construction projects, and the elaborate machinery of church administration all required financing. The Italian banks, especially those based in Florence and Siena, became the bankers to the Pope. In return, they received papal protection, favorable business terms, and access to the church's vast network of properties and revenues across Europe. This relationship was mutually beneficial but also problematic. The bank's association with the papacy gave them legitimacy and access to enormous financial resources. But it also entangled them in the politics of the church and exposed them to the financial volatility of an institution that was itself often struggling with debt. The greatest beneficiaries of this relationship were the Florentine super companies. The Bardi and Peruzzi in particular became the principal bankers to the Pope, handling papal revenues, making loans, and facilitating transfers of church funds across Europe. But lending to monarchs and the church was a dangerous business. The Bardi and Peruzzi discovered this in the most painful way possible. In the 1330s, as King Edward III of England prepared for what would become the 100 Years' War with France, he needed vast sums of money. He turned to the great Florentine banks. The Bardi and Peruzzi made enormous loans to Edward, 900,000 gold florins to the Bardi and 600,000 to the Peruzzi, staggering sums for the time. In return, Edward granted them monopolies on English wool exports, which they needed for Florence's textile industry. He also assigned them royal revenues, customs duties, taxes, and other income streams which the banks could collect directly to repay the loans. This wasn't traditional banking. It was more like privatization. The Italian banks were effectively running parts of the English economy. They collected royal revenues, paid the king's budget, and controlled England's most valuable export commodity. But it was also incredibly risky. The bankers knew they had overextended themselves, yet they felt compelled to keep lending. If they stopped, they would lose everything they had already lent. Moreover, they needed Edward's permission to export wool, and continuing to lend was the price of that permission. The war began in 1339. It dragged on year after year, consuming resources at an alarming rate. Edward's expenses mounted. The quick victory he had promised never materialized. By 1343, it became clear that the king wasn't going to be able to repay his debts. Edward never formally repudiated his obligations. Instead, his commissioners disputed the amounts, conducted audits, scaled back the acknowledged debts, and then simply never paid what was owed. The amounts lost were catastrophic, the equivalent of hundreds of millions in today's currency. The Bardi and Peruzzi weren't just losing their own capital. They had borrowed heavily from depositors across Italy. Wealthy families, merchants, and even smaller banks had entrusted their money to these great houses, confident in their stability and reputation. When the super companies collapsed, the damage spread far beyond Florence. The Peruzzi Bank went into bankruptcy in 1343. The Bardi struggled on for 3 more years before they too were liquidated in 1345. Smaller Florentine banks that had lent to the super companies or held their bills of exchange also failed. The crash sent shockwaves through the Italian economy. At roughly the same time, the King of Naples defaulted on debts of 100,000 florins to each company. The King of France exiled the Italian bankers and confiscated their goods. It was a perfect storm of sovereign defaults. The collapse also had political consequences. In 1342, desperate to save themselves, the Bardi, Peruzzi, and other great banking families backed Walter of Brienne, Duke of Athens, in a bid to make him ruler of Florence. They hoped to control his policies and somehow rescue their firms. The attempt failed. The bankers ousted the Duke in 1343. Disappointed in their hopes. It was too late. The damage was done. Giovanni Villani, the great Florentine chronicler, who was himself a partner in the Peruzzi Company, bitterly lamented the destruction of Florence's commercial importance. He attributed it to the justice of God, punishing the sins of the people. Some modern economic historians have concluded that this banking collapse was a major cause of a Great Depression that lasted through the 1340s and beyond, though this claim remains debated. The crash of 1345 marked the end of the medieval supercompanies. Smaller firms survived and eventually prospered, but they never commanded the vast capital and extensive networks of their predecessors. The new generation of Florentine banking families, the Pazzi, Rucellai, Strozzi, and Medici, learned from the mistakes of the Bardi and Peruzzi. They would be more cautious about lending to sovereigns, more careful about risk management, and more sophisticated in structuring their operations. From the ashes of the Bardi and Peruzzi, a new banking dynasty would emerge that would surpass all that came before: the Medici. The Medici family's origins were humble. They came from the rural Mugello Valley north of Florence, migrating to the city in the 12th century. By the late 13th century, they were established merchants trading in Florence's old market. But it wasn't until Giovanni di Bicci de' Medici founded the Medici Bank in 1397 that the family began its meteoric rise. Giovanni was a shrewd businessman who understood the lessons of the supercompany collapses. Instead of creating one massive company with branches controlled by a central board of directors, he structured the Medici Bank as a series of separate partnerships. Each branch in Rome, Venice, Geneva, Lyons, London, Bruges, and elsewhere was its own legal entity, with local partners who invested their own capital and shared in the profits. This structure had several advantages. It incentivized careful management, as each branch manager had his own money at risk. It limited liability, so that if one branch failed, it wouldn't automatically drag down the others. And it allowed the bank to adapt to local conditions in different markets. The Medici Bank also benefited from Giovanni's long-standing relationship with the papacy. The Rome branch, in particular, handled papal finances, collecting revenues from church properties across Europe, facilitating payments to Rome, and making loans to the Vatican. This papal connection was enormously profitable and gave the Medici unique access to power. Giovanni died in 1429 with a fortune estimated at 180,000 gold florins, making him one of the wealthiest men in Europe. His son Cosimo de' Medici inherited the bank and took it to even greater heights. Cosimo was more than a banker. He was a statesman, a diplomat, and a patron of the arts. He understood that political power and financial power were inseparable. In 1434, after a brief period of exile orchestrated by rival families, Cosimo returned to Florence and effectively took control of the city. He never held official title as a dictator or king. Florence remained nominally a republic, but Cosimo ruled through his wealth, his networks, and his ability to manipulate the city's political structures. Under Cosimo's leadership, the Medici Bank became the largest and most respected financial institution in Europe. The bank pioneered several innovations that became standard practice. One was the systematic use of double-entry bookkeeping. While the technique had been around for decades, the Medici made it standard operating procedure across all their branches. This forced competitors to adopt the same system just to remain competitive. Double-entry bookkeeping allowed the Medici to track assets and liabilities with precision, to calculate profits accurately, and to spot problems early. Another innovation was the concept of a holding company. The Medici Bank in Florence acted as the central authority, holding partial ownership in each branch but allowing substantial autonomy. This model of branch banking, with a parent company coordinating multiple semi-independent operations, prefigured modern multinational corporations. The Medici also perfected the use of letters of credit. A merchant could deposit money at a Medici branch in London and receive a letter of credit that could be redeemed at a branch in Florence, Venice, or anywhere else in the Medici network. This made international trade dramatically easier and safer. The bank created an early form of the modern check, A client could write a promissory note against their account at a Medici branch. The note would be presented for payment, and the client's account would be debited. This was revolutionary. It meant merchants no longer needed to carry cash or precious metals at all. They could conduct business through paper instruments backed by the bank's reputation. The Medici were also masters at circumventing usury laws. Through letters of credit and bills of exchange, they could earn substantial returns without appearing to charge interest. A merchant might exchange florins for pounds in London at one rate, then exchange pounds back to florins in Florence 90 days later at a different rate. The difference wasn't interest. It was merely a currency exchange. Except, of course, that the exchange rates were carefully calculated to ensure the Medici made a healthy profit, often around 20 to 22% annually. This clever arrangement kept the bank on the right side of church law while generating the returns needed to sustain and grow the business. Cosimo also understood the importance of supporting the church and the arts. The Medici became legendary patrons, commissioning works from artists like Donatello, Fra Angelico, and Filippo Brunelleschi. This patronage served multiple purposes. It burnished the family's reputation, demonstrated their piety, and helped assuage any guilt about the dubious financial practices that generated their wealth. In Renaissance Florence, art and culture were forms of soft power, and the Medici wielded them expertly. The marriage of Cosimo to Contessina de' Bardi around 1415 was also significant. Contessina came from the once mighty Bardi banking family. After their collapse, the Bardis had fallen on hard times. The marriage gave Cosimo access to the Bardis' remaining connections and expertise, while the Bardis gained the support of Florence's rising power. When Cosimo took control of Florence in 1434, he restored the Bardis' political rights and exempted them from certain taxes, cementing the alliance. By the mid-15th century, the Medici Bank was at the height of its power. It had branches in all the major commercial centers of Europe. It managed the finances of the papacy and numerous other clients. It was producing enormous profits. Some estimates suggest annual returns of 13,000 to 18,000 florins in good years. But success bred complacency, and complacency bred problems. After Cosimo died in 1464, leadership passed to his son Piero, known as Piero the Gouty, due to his poor health. Piero lacked his father's business acumen. He called in loans aggressively, creating financial panic in Florence. He struggled to manage the bank's far-flung operations. His brief tenure, he died in 1469, saw the beginning of the bank's decline. His son, Lorenzo, known as Lorenzo the Magnificent, was a brilliant statesman and patron of the arts but a poor banker. Lorenzo focused on politics and culture rather than business. He used the bank's resources to pursue diplomatic goals and to fund lavish artistic projects. Branch managers, left unsupervised, made poor decisions. Loans to politically important but financially unreliable clients went bad. The bank's profitability eroded. By the 1490s, the Medici Bank was in serious trouble. The branch in Bruges collapsed. The London branch failed. The Rome branch, so long the crown jewel of the operation, lost its papal accounts when the Medici fell out of favor with the Pope. One by one, the branches closed or went bankrupt. In 1494, the Medici family was expelled from Florence in a political upheaval. The bank that had dominated European finance for nearly a century ceased operations. Though the Medicis would later return to power, two of them even became popes, their banking empire never recovered. The legacy of the Medici Bank, however, endured. The innovations they had pioneered, double-entry bookkeeping, letters of credit, bills of exchange, branch banking, the holding company model, all became standard practices. Other banking families in Florence, Genoa, and Venice continued these traditions. Italian financial techniques spread to Northern Europe, where they were adopted by German, Dutch, and eventually English bankers. But Italian dominance itself was fading. By the 16th century, the center of banking was shifting northward. The discovery of new trade routes to Asia and the Americas reduced Italy's role as the essential intermediary between Europe and the East. The rise of the Ottoman Empire disrupted Mediterranean trade. Wars and political instability in Italy drained resources and created uncertainty. Northern European banks, particularly in southern Germany, Antwerp, and Amsterdam, began to eclipse their Italian predecessors. These northern bankers built on Italian foundations but adapted them to new circumstances. The Fogger family of Augsburg, for instance, became the wealthiest bankers in Europe by the 1520s, financing emperors and kings much as the Bardi and Peruzzi had done centuries earlier. By the 1600s, Amsterdam had emerged as Europe's new financial capital. The Dutch developed innovative financial instruments like tradable stocks and bonds. The Bank of Amsterdam, founded in 1609, pioneered new approaches to deposit banking and became the most important bank in Europe. In the 18th century, London surpassed Amsterdam as the center of global finance. British banks and financial markets became the dominant force in the world economy, a position Britain would hold until the 20th century. But all of these later developments, the stock markets, the central banks, the international financial networks of the modern world, rested on foundations laid by medieval Italian bankers. They invented the techniques of double-entry bookkeeping that remain fundamental to accounting today. They created the bills of exchange that evolved into modern checks, promissory notes, and letters of credit. They pioneered international branch banking and the holding company structure. They developed methods of risk management and financial transparency that became essential to business. This insight remains true today. Modern banking still depends on the same fundamental principles the Italian bankers discovered: sound money, accurate record keeping, transparent accounting, risk management, and above all, trustworthiness. The journey from those wooden benches in medieval Italian marketplaces to the gleaming skyscrapers of modern financial districts spans nearly 1,000 years. But the connection is direct and unmistakable. Every time we use a check, every time we transfer money between accounts, every time a business balances its books, we're using tools and techniques that medieval Italian bankers invented. They created modern banking not through grand theories or government mandates, but through practical necessity. They needed to move money safely across dangerous distances. They needed to keep track of complex transactions involving multiple parties and currencies. They needed to make profits while nominally adhering to religious restrictions on lending. They needed to manage risk in an uncertain world. In solving these problems, they built the financial infrastructure of the modern world. The techniques they pioneered spread from Florence and Venice to Milan, Genoa, and beyond. Then northward to Germany, the Low Countries, England, and eventually across the entire globe. The story of medieval Italian banking is more than just a history of financial innovation. It's the story of how commerce and culture intertwined, how necessity drove invention, and how a handful of ambitious merchants transformed the way humanity conducts business. Consider the sheer scope of what these Italian bankers accomplished. In the span of roughly 3 centuries, from around 1200 to 1500, they took banking from rudimentary money-changing operations to sophisticated international financial networks. They created accounting systems that are still in use today. They developed financial instruments that remain fundamental to modern commerce. They established principles of banking that endure centuries later. And they did all of this while navigating extraordinary challenges. They operated in a world where charging interest was considered sinful. They worked without modern communication technology messages, traveled only as fast as horses or ships could carry them. They faced constant political instability, with wars, revolutions, and territorial disputes disrupting trade and threatening their assets. They dealt with dozens of different currencies, each with varying degrees of reliability. They extended credit to monarchs who could, and often did, simply refuse to repay their debts. Yet despite all these obstacles, Italian banking flourished for centuries. The success wasn't accidental. It was built on innovation, careful management, and an understanding of human nature. The Italian bankers understood that reputation was everything. A bank that failed to honor its obligations even once would find its letters of credit worthless and its business destroyed. This is why the Templars punished theft so harshly. This is why Florence maintained the gold content of the florin for 3 centuries. This is why the Medici were scrupulous about honoring letters of credit even when individual branches failed. They also understood the importance of spreading risk. The structure of the Medici Bank, with its semi-independent branches, was a masterclass in risk management. When the Bruges branch collapsed, it didn't bring down the entire empire. Compare this to the Bardi and Peruzzi, whose centralized structures meant that Edward III's default destroyed both companies completely. The Italians grasped the power of networks. The great banking houses didn't just have offices in major cities, they cultivated relationships with merchants, nobles, church officials, and government administrators across Europe. These networks provided information, business opportunities, and political protection. A banker in Florence might never travel to London, but through his network, he could make informed decisions about English trade and politics. They recognized that finance and politics were inseparable. The banking houses that thrived were those that could navigate the treacherous waters of medieval politics. Cosimo de' Medici's genius lay not just in financial acumen, but in political savvy. He understood that controlling Florence's government even informally gave the Medici Bank advantages no competitor could match.